Hey everyone, and welcome back to Vertical Blocks, where today we're excited to be joined by Alex Svanevik from Nansen AI, as well as Simone Pomposi, Chief Marketing Officer of Fantom. So thanks guys for joining us today.
Happy to be here.
And thank you, Alex, for coming. Thank you, Juan.
Yeah, we've really been looking forward to this conversation. I know that a few different members of the Fantom team are keen users of Nansen for different reasons, and obviously the main reason being better understanding what's going on in a very sometimes confusing blockchain environment, despite all this data being on chain. And I think that's where the tool really shines. So maybe as a starting point, Alex, a good place to give our viewers an idea of where this conversation might go is if you could maybe share a little bit about, what exactly is Nansen in your words, and how did you come to build it?
Yeah, absolutely. So we started building Nansen back in 2019. It sort of built on a few other open source components that my co-founder Yevgeny had built back in 2018. But the premise was kind of, as with all startup ideas, there is kind of a market component. You see an underserved customer segment, and then that's on the one hand. And on the other hand, you have kind of an impetus or a drive to create an interesting product or some interesting technology from the other side. So the market gap that we saw was that crypto investors didn't really have a good way to understand what was happening on the blockchain in real time. They had access to kind of free products like Etherscan or CoinMarketCap, but they weren't really geared towards kind of surfacing the signal in what's useful for you as an investor on the blockchain. And then on the other side, you did have access to relatively sophisticated products for blockchain analytics in the anti-money laundering and compliance space, players like Chainalysis, Elliptic, and so on. And so we kind of felt that the man in the arena or the woman in the arena who wants to actually be active in crypto investing, using different protocols, tokens, and so on, they should have access to really high quality blockchain analytics to understand what's happening on the blockchain. So that was kind of the market need, and we had a lot of sort of anecdotal input that people wanted something like this. And then from the other perspective, myself, Yevgeny, and our third co-founder, Lars, are also data people, like data enthusiasts. And so we saw that we had what you might call like the technological insight that it's not enough to only have blockchain data. You also need to enrich that blockchain data to make it more actionable and more useful. And so we basically started with that premise, building up the world's largest database of wallet labels. And we kind of took these wallet labels, for example, addresses that belong to Binance or even to funds like Alameda, Three Arrows, and so on. And then we created one analytics platform where people could go in. They didn't need to know how to code. They could just start digging around and surfacing useful insights and drilling down to the lowest granularity of the blockchain data. So that was kind of how we started it. And we rolled it out. Well, we launched it in April 2020, 1 month after the pandemic started. And then there were kind of two initial phases that drove the growth of the product. The first was DeFi Summer in the summer of 2020, when we had a lot of users coming in using Nansen to chase the smart money and seeing where people were yield farming and which tokens they were buying and things like that. And then a year later, we had another massive run with the NFT craze that was going on in 2021. And it's interesting actually, because the NFT parts of the product, we hadn't really planned them for very long. We kind of saw that this was an interesting space and there was activity going on. Of course, we knew about NFTs from many years before with CryptoKitties and CryptoPunks and all that. But we decided to roll out some NFT dashboards, and they kind of took the whole company to another level. And many people know Nansen mostly as an NFT analytics product today. But actually, we give you analytics on tokens, on pretty much everything that happens on the blockchain. And so those were kind of the two first waves that we could ride. And since then, we have been focusing on trying to make Nansen the information super app of Web3. So that means we now have multiple different products that fit into kind of one suite of blockchain data related tools or information related tools. And a lot of other things have happened too. We've shifted a lot of our focus, or at least a lot of our customers are now coming in from the institutional segment and more enterprise-oriented customers, whereas in the beginning it was almost exclusively individuals and retail investors. So we've got more of a balance now between individuals and institutions. But yeah, that's kind of what we do, and our mission as a company is to surface the signal and create winners in the future of finance.
So between these individuals and institutions, it seems like at the beginning, you were focused on making data accessibility or democratizing data accessibility for all, right? Making it possible so that anybody could essentially purchase access to this same sort of high quality information that, as you said before, was only available in AML type scenarios.
Yes.
At what point and how do you think you've shifted to also try to attract the enterprise? And what's the value in it for the enterprise when these companies oftentimes have data engineers and data analysts in-house that could theoretically build out their own versions of these products? How do you see yourselves presenting Nansen in this conversation of buy versus build?
Yeah, it's really interesting, and that's exactly the right framing actually when we have conversations with customers, because they could try to build it themselves, but it's going to take a really long time, and it's also going to cost them way more than what it would to just use our product. So that is actually the right framing and how we think about it when we speak to customers. I think there are a few different reasons why we have ended up at this point getting kind of a balanced revenue base from institutions and from individuals. Frankly, it's something that I expected would happen. I thought it would take longer. Let's say we were close to 90% individuals on the revenue side a year ago, and now we're more like 50-50. I thought that would take maybe 2 or 3 years, but a few things happened. The first one is that we went from kind of a raging bull market to a bear market, and typically individuals will have the fastest turnaround, meaning they're all, on the one hand, on the way up, they might be the ones who will kind of ape in the fastest. They don't have to go and sort of discuss it internally with some like procurement department, or they don't really think so much about the contractual work that a business would do. They will just see the product, they see the value, and they buy it, and it takes 5 minutes. Whereas businesses, they need to often escalate it, maybe discuss it with someone else. They need to figure out if it's the right tool, look for alternatives to justify purchasing it, and so on. So there's kind of always going to be more inertia when it comes to businesses getting access to any tools. And it's the same on the way down in a bear market too. So an individual might say, hey, actually, I think I'm just going to take a break from crypto, for a while until the markets recover. Or, even worse, maybe they literally just got wrecked, and then they don't really have much trading to do anymore. And of course, then you might not want to pay for an information product. But it's similar with businesses, right? That they're in this for the long run. They might have raised money, and even funds might have raised money from external LPs. So they don't just shut down because Bitcoin price goes down 20% over the course of a week. There's much more inertia there, and it's more like long-term thinking. And so what we thought was, now that the markets are changing, it's a good chance for us to really double down more on the B2B and the institutional segment. So this is mostly, I would say, something we knew was going to happen. But also, when you try and go to market with institutions, you need to have really good salespeople. You need to have customer success people. You need to have sales operations. There's a lot of stuff that goes into going to market with businesses and institutions. And that takes time to build out. And so when we were growing extremely fast last year, we literally had no salespeople. It was all just inbound people buying the product on the website. But so now there's kind of a bit of a kind of pent up demand, let's say, of businesses that wanted to come on board as customers, but we didn't really have good people who could help them like demo and like make sure that the use case matched the product and so on. And so we're kind of catching up on that now. So that, there are some of these kind of mechanistic explanations for why we have made that shift. We're definitely not going to abandon the individual segment at all. Like, we're still putting a ton of effort into building the product really, really good, and we have a lot of new products that are also free to use. But I really think that if you want to be the category leader for information in Web3, you have to cater to both the individuals and also to the institutions.
Yeah, and Alex, if you don't mind, if I jump in there real quick, because there are two interesting things I think about Nansen. One is that, if I'm not mistaken, you and your co-founders actually just recently met in person, right? Am I mistaken?
That's true.
Yes.
Yeah.
So that's for me, it's very interesting. It's something that I would say very rarely happen. I mean, it happens a lot in crypto, but in general businesses, it's something that very rarely happens, that co-founders only meet after a certain period of time. And also, it would be interesting to learn more about this big scaling up that you guys have been gone through since, as you said, last year, and how it worked internally from, I guess, a very small company to actually hiring very aggressively. Because I'm still seeing all the time that you guys post a lot of ads on Twitter and so on. So again, I think, going back also to what Juan was saying, and with a focus from a perspective of a builder or someone that wants to start a company in crypto, this is all information that is definitely interesting to hear about.
Yeah. So it's true. Evgeny, Lars, and myself, we started the company remotely. I think the first lines of code we wrote for Nansen, I was in Japan at the time. I was a bit nomadic, like you are now these days, Simone. And then Evgeny was in Bangkok and Lars was in Oslo. So we were in different parts of the world, and we had no choice but to run the project completely remote first. And I think we started in Slack, and then we moved over to Discord, and then back to Slack or something like that. But it's always been like a virtual office. And it's funny because you're right. A couple of weeks ago, we all met for the first time in person here in Singapore when Lars flew over. I had met both of them before, but they had not met each other, and we had never been in the same room at the same time. And I posted it on social media, and a lot of people noticed and thought it was incredible. But I posted it on Twitter and I posted it on LinkedIn. I think on LinkedIn it caused more of an uproar because it was so foreign to people who are not in crypto that that's even possible. Like, now I kind of take it for granted. Like, yeah, of course I interact with most people online when it comes to work in crypto. Anyway, like, that's just the default mode of meeting people. But I guess on LinkedIn, there's still people who are getting forced to go back to the office and things like that. But yeah, so that's how it first happened. And then when I think it's actually been really good for us when it comes to scaling. I think it's easier in some ways to scale. There are some benefits to running a remote first company when it comes to scaling. The first one is that you can literally hire from wherever you want in the whole world. So it expands the talent pool by many folds, right? So we are headquartered here in Singapore. Singapore has about 5 million people. But if you can reach out to like 8 billion people, that's obviously a much larger talent pool. Now, maybe not all of those 8 billion people are the right fit for us to work with us, but gives an idea of the order of magnitude when you start thinking about a global talent pool instead of a local one. And then the other thing is, when you run a remote first company, you default to written communication, which is really good for people who are coming in because they can kind of catch up on stuff a lot easier. So they can look through the different Slack channels and they can kind of catch up on conversations. They can see what's happening. We also have a very, very large Notion that we use for knowledge management internally, which a lot of people also use. And we've had to groom it and make sure it doesn't go completely out of control. But it's something that people say now when they join is something that's incredible. And some people haven't seen it in other companies. Not that it's perfect. This is always, it's always a bit messy. That's how it should be. But it helps a lot to have that kind of written first approach to communication. and it helps a lot in scaling. And then yeah, I guess those are maybe the two main benefits. And of course, we did raise capital. For when we started Nansen, we thought we were just gonna run it kind of like a bootstrap company, not take any capital. And we were, in fact, generating revenues. And we didn't really touch any of the funds we raised until, you know, maybe, let's say, 1.5 or 2 years after we started, more or less, because we were actually profitable last year. We're no longer profitable, I'm happy to say, because we've managed to catch up on the hiring compared to how much we're growing the revenues, which is normal. We kind of, at some point, we weren't able to hire fast enough. And now we are in this kind of investment and expansion mode, right? Where you're trying to build for the long term. We are 150 people now in the company, so it's quite large. Yeah, so that's, you know, there's a lot. I guess like one more thing we could talk about, or I can mention briefly, is that when you're building a startup in crypto, I think it's a little bit different than if you're building kind of a SaaS company in another sector. The first difference is that you have these market cycles that you have to be aware of. So you might not have this kind of hockey stick up and to the right chart forever, because crypto doesn't really work that way. You have these cycles, people coming into the space and people leaving the space. And that's just something you have to be prepared for, both from a psychological and morale perspective, but also from a treasury management perspective. So, you know, I'd been through a bear market before, and I got laid off in the last bear market when ETH was at $80. So I knew that, you know, I didn't want to do that to our employees. And I knew that in the bull market, you should probably raise money even if you don't need it. And so that's kind of another thing that, of course, helped a lot with scaling. Now it helps a lot with scaling because it gives a lot more comfort to employees knowing that we have many, many years of runway. But it also means that there's no existential risk for the company as such.
Yeah, I think it's an interesting hybrid that, you know, as you described it, the shift from B2B and SaaS to crypto, and it seems like Nansen is almost a hybrid. I mean, you know, you have this sort of SaaS revenue model. You know, I know it's a subscription that can be pay as you go. It's not necessarily ARR that's locked in, but you have this model while at the same time the CEO is a pudgy penguin. And so I'm wondering, like, you know, like on LinkedIn, first off, how do people react to that sort of thing? Because you said the initial kind of reaction to crypto stuff is very foreign and alien. But, you know, on a more serious note, I'm curious, you know, when you decided to set up operations from a business perspective, and you were looking at how are we going to look at revenue flows, how are we going to start to look at these sorts of metrics. A lot of other companies may have said, you know, we're going to have a governance utility token, and that's going to be used to access the platform, and then we'll provide liquidity for that on the secondary market. But no, you guys decided to say, no, we're going to go the Asana or the Google or whatever other cloud-based platform type model, where there's almost like pay per use, if you want to think about it for more retail and commercial. And then maybe I think you have sales reps, right, that may close like enterprise multi-year deals. If I'm not mistaken, that's kind of the vibe I get from looking at your contact us page, because I used to work in software sales myself. So I'm curious, you know, how did you choose that approach over the approach that a lot of other crypto native companies might have gone with?
Yeah. So one thing that I recognized relatively early after being a part of the kind of ICO boom and bust in 2017, 18 was that it's already very difficult to build a world-class product that people love. And if you have to fit a token into it, you almost have to innovate in like 2 dimensions at once, making the job a lot harder. And I think there are a lot of examples of this where people have actually built a really good product, but they never really cracked the code on what to do with the token. And in fact, the token probably got in the way of the product many times. And I'd seen this firsthand, at least in 2 different places, on projects that I had kind of worked with. And I thought, you know, let's just focus on building a really good product. And there is a relatively straightforward business model here, which is just that, you know, you just pay every month or every quarter, every year to use the product. And the other, I think, more subtle point, which is related to that, is if people are paying for your product, it's probably a useful product. And so when you think about product market fit, you really want to get a strong signal from the market that what you're building is useful to them. And this is kind of a concern I have about the whole crypto space, that we actually sometimes do the opposite in Web3, right? Where we incentivize people to use our products. And that makes sense sometimes because you're kind of bootstrapping a network and you're creating kind of stakeholders in a larger ecosystem. But you do lose a lot of that signal that is very valuable early on to say that this is a product that actually is valuable to me. And as I said, if someone is willing to pay to use your product, that's a very strong signal that it's useful. But many people, when we started Nansen, many people thought no one's going to pay for an information product in crypto because everyone was used to everything just being free. And so we had a lot of people kind of doubting that business model. And we went, especially when we started speaking to VCs, you know, there was a lot of, let's say, nudging towards us launching a token instead. But I'm glad we held our ground because, you know, I always felt, you know, it always felt wrong to me to launch a token without really knowing what you're going to do with it. And the third thing I would say on that is I kind of have started to view tokens as like a form of community debt. So if you're launching a token, you're basically taking on debt to the people buying it. Like they will come and expect something. And it doesn't even matter if you're giving out the tokens for free because someone's going to buy it on the secondary market. And then they will have expectations. So they'll come to you and they say like, you know, when launch, when app, when, you know, whatever, when partnership. And so I think we were somewhat disciplined to avoid that trap. I think there's a chance we would have kind of prematurely launched a token if we hadn't gone through that boom and bust from the ICO phase. And I say this as someone who fundamentally believes in tokens and the tokenization of all assets, but we haven't yet come up with the best token models, I think, that makes sense. And there was also like a lot of regulatory issues standing in the way with regards to, you know, securities laws and things like that. But that's kind of the short version. That, you know, number one, we felt it was difficult to innovate on two dimensions at once. Let's just focus on the product. You know, number two, we had seen how the tokens could get in the way a lot. And then number three, there was a pretty clear business model, you know, in front of us. And so why not just try with that? And who knows, if you figure out the token part later, you could always tokenize it then, right? So that's the other thing, where maybe at some point we start looking at tokenization as more of a replacement of going public. You know, instead of doing an IPO, you might tokenize. Whereas the model so far has been that you kind of tokenize before you build the product. But yeah, I would like to see more projects actually tokenize later. I think that's healthy.
Yeah, I mean, it's interesting to hear that sort of idea of first find product market fit, know that people are willing to pay for your product, and then you can issue a token rather than the token almost introducing noise and leading you to believe that you're offering a valuable product, when in reality what's happening is people are either getting free money from you or they are expecting an increase in the price of the token and therefore are using that token to use your product, which leads you to build the wrong things for the wrong audience. So
Exactly.
I absolutely see it from the same perspective of that a lot of things can be tokenized that haven't been tokenized yet, but maybe it's just the order in which things are done, right? Maybe not. Maybe the order isn't release a token without a plan and then attach a plan to it, right? So yeah, that's certainly a way to start looking at it. And I think more people now with the amount of tokens floating around that haven't really quite found a use or a purpose, people will probably start to gravitate towards that. One thing I wanted to ask you about was I was reading an essay about this earlier this week, and I wish I could give a shout out to the author, but I can't recall who was talking about it. But they were essentially talking about product market fit versus crypto market fit. And product market fit in the Web2 world might mean sort of vanity metrics that product managers install, like, for example, this user swiped between two different pages, or they drag this down to this box. Whereas in crypto, what we're looking at more is the sort of metrics that you might find on Nansen, like daily active users, in this case wallets, or monthly active users, and that means they have to have made a transaction or have done something that contributed value in some way to the network. So when you're thinking about product market fit in crypto, how does that differ from the kinds of metrics that you'd be looking at if you were just running a traditional software company where you were, say, offering cloud services to somebody, or even a retail consumer app like a dating app or a grocery shopping app?
Yeah, it's a great question. I think, first of all, it might make sense to think more about capital and liquidity rather than users sometimes. So are you able to, so for example, if you're a DeFi protocol, are you able to actually attract liquidity? It doesn't really matter that much if it's like 100 or 10,000 people. If at the end of the day, your business model is tied up to how much TVL you have or how much volume you have, then it might make sense to think more in terms of capital and liquidity than number of people. I think for things like NFTs, though, especially with profile pics and so on, then you go back to thinking more in terms of number of humans or number of addresses and things like that. But still at the transactional level, like you pointed out, you're typically looking at, for example, for OpenSea, what's the weekly active users or traders, let's say, not just how many people are kind of browsing the gallery in OpenSea, right? So I do think there's this, if you think about it from an on-chain perspective, you really only see what people are transacting, right? If you think about looking at the on-chain data, and that happens to also be the strongest signals that you can typically get. So for NFTs, it's typically oriented more around people. With DeFi and tokens, you tend to think more in terms of liquidity or capital. But you also do have some kind of hybrid models where you can think about tokens that focus on DAOs and so on. And then you might think of like weekly active voters or proposals or percentage of the token base that is actually voting on certain proposals. So it depends a little bit on what the different types of products are. Yeah, and we're kind of still figuring this out, which is I think one of the very interesting reasons to be in crypto, that the playbook hasn't really been written yet. Like, we're writing it as we go, and it's a good idea to stay kind of to observe what other projects are doing and lean into slightly different ways of doing things. To me, when Compound launched, that was I think it was late 2018 or maybe early 2019. I can't remember exactly. But when Compound launched, that was kind of felt like a switch in. It was a huge event where I thought, wow, they've launched these tokens, the CUSDC and CDAI and all that stuff, CETH, and the tokens aren't like their own kind of shitcoin that you buy on CoinMarketCap. The tokens have a real purpose, and the purpose is to make the protocol work. And I just remember seeing that and thinking, like, this is so obvious in a way. Like, why hasn't anyone built this before? But it was also so revolutionary, and it kicked off, of course, DeFi Summer later on, and sparked a bunch of forks and innovations on top of it, and people taking it in different directions. But I think it's really important to just stay very curious and see what people are doing in the space. And of course, the best place to observe that is by looking at the on-chain data itself.
So I just wanted to interject real quick and say that the author of this crypto market fit is Jeff Morse Jr. from Chapter 1. I just wanted to say that because
Nice.
I would feel it's good to give credit where credit is due. It's a really interesting article. Maybe we can link it here for whoever wants to read it. But so, okay, one of the things I want to ask you about, speaking of attracting free users, then converting those users to paid users if they're more advanced traders or they want to become more advanced traders, and then of course closing deals with institutions and enterprises, is this sort of problem of, or it's a double-edged sword, right? Because with Web3, you have open source, composability, interoperability, which means that effectively the moat for a company sometimes can depend on the veracity with which their community, and here community has many different meanings, some very meaningless and some very impactful, can defend that moat of that product, right? Because for example, we think back in the day with Uniswap and SushiSwap and the vampire attack that occurred. For those who aren't familiar, essentially it was just the idea of whatever you were getting here, you can get more here now for the exact same thing. And they vamped all of that liquidity away into SushiSwap. And that's a very simplistic way of explaining it. But so effectively, what I think that showed back at the time is that with incentives or misincentives, the moat can quickly disappear. So my question is, in this world where all of these things are open source, there's interoperability, composability. How does a company defend its moat if it hasn't issued tokens in Nansen's case, for example, it has a recurring revenue model? Because you made this interesting comment of, I think you were joking, but on Twitter you said, steps: 1, have a big treasury; 2, switch off fees; 3, drive revenues to 0; 4, survive while competitors die; 5, bull market returns; 6, switch on fees; 7, profit. And I think you were referring to some of the stuff that's going on in the NFT royalties marketplaces, right?
You also see exchanges running that playbook as well, I think.
I mean, look, so I've been referencing a lot of things, but I've been reading this book. It's really interesting, called Proof of Stake by Vitalik Buterin. And in one of his early chapters from 2014, he talked about precisely this, about the dangers in centralization of if an exchange, raised a lot of capital, made it the most seamless interface and experience, attracted users with near zero fees, essentially captured all of it had governance capture at the utmost percentage, and then it switched on fees, right? And obviously there are business advantages and competitive, compelling reasons to do so, but it also introduces risks. But here, what I'm more so interested in is when you have all these other alternatives where they may be able to fork things, they may be able to quickly try to replicate things that exist. And we see it with everything, right? A successful product comes out, there's 10 forks the next day, and then the dilution or the cannibalism becomes everybody's FOMO to be early to the next thing, even though that thing may never even take off in the first place. So my question is, how do you see yourselves defending that moat against these sorts of products that may come in and take a similar approach, seeing as you don't have that native token?
Yeah, it is really interesting. And Uniswap successfully defended that vampire attack in the sense that they're still the most used blockchain application in the world. So they were able to defend it. I guess you could argue, was that because they launched the Uni token, or is it just because they had so much network effects already accrued and a brand that was so strong that people just kept using that instead of Sushi after the liquidity incentive started becoming less interesting with Sushi? I think another very interesting example is OpenSea versus LuxRare, where LuxRare was kind of trying to do something similar as SushiSwap. I think in the case of OpenSea, it just showed that OpenSea has an even deeper moat, in my opinion, than Uniswap. And that, I guess that's a whole discussion we could, or rabbit hole you could go down. I think in brief, it's because OpenSea has all the inventory, and inventory is much more important with NFTs than with fungible tokens, because you really need to feel like you have everything in one place. When you're looking for that perfect pudgy penguin, for example, you need to have the whole selection of the floor in one place to actually be happy to use it. And later on, you had Gem, the marketplace aggregator, which I think ended up being a larger threat to OpenSea because they were aggregating all this inventory, which was, at the end of the day, kind of the moat that OpenSea had. So it is and there's another one you could mention, which is Lido. You kind of hinted at staking, and I think Lido has an extremely deep moat. Full disclosure, I'm a Lido DAO member, but I think they have a very deep moat because of the liquidity. And so with Web3, it is very interesting to think about which products and businesses actually have moats in a kind of permissionless, composable world. I think if you think about Nansen specifically, we kind of fall more into the Web 2 camp here, I think, the way we are structured. And so, you can't really easily, I mean, there's no permissionless way to build on Nansen, for example, or to fork Nansen because it's closed source. And this is also something that I struggled with earlier on. We talked about, should Nansen have a token, or why didn't we issue a token? I always felt that there was kind of some kind of link between open source projects and tokenized projects. Like, how do you tokenize something that's closed source? At the same time, there are examples like Binance, Nexo, FTX that are closed source projects, largely, but they have tokenized. So there are some examples where you can tokenize even if you are a closed source proprietary business. But I think with Nansen, the main moats we have are, we have the best blockchain data in the world, and it's not just public data, which people tend to think, right? We also enrich the public data and curate it with wallet labels. We have more than 130 million. I think it's maybe closer to 200 million wallet labels now. And those wallet labels, they don't come with a node. So if you try to spin up an Ethereum node, you want to figure out which addresses belong to Binance. That's information you're going to have to get from somewhere else because it doesn't come with a node. And that was, going back to the beginning, kind of one of the key technological insights we had when we created the company. So there is a moat there. I think it's hard to, and we call this attribution, to label wallets. It's hard to do attribution. It's hard to do it with high precision and at scale. I do think that there are also other moats we can build over time. In fact, you could argue that brand is a moat to some extent, because with information and data, you also want to trust that the information is accurate, that the data is high quality, and so on. And I do think that there is some degree of moat to build up there as well. There's a lot of incorrect data and incorrect charts flying around on crypto Twitter. And it might not matter that much if you're just retweeting it, but if you're investing based on it, that could be a big problem for you. I've seen examples of dashboards made on a hobby basis that have had an error in the order of 10x when it was estimating like revenues for a protocol and things like that. And that's not something that you want as an investor, right? So I do think there's a moat that you can build up around brand, trust, and quality as well. And then the third area where I think we want to spend more time on is to create a stronger community around Nansen itself. And this is where Nansen, I think, goes beyond being a Web 2 company, takes a step into Web 2.5 or even Web 3, let's say. We have a product called Nansen Connect, which allows you to communicate between different wallets. So you can just literally sign in with your Web3 wallet. Could be through MetaMask, could be through Wallet Connect. And then you can start joining token-gated channels, because the wallet shows us which tokens you have. And so there's a Pudgy Penguins community within Nansen Connect. You can only join that if you have a Pudgy Penguin in your wallet. And there's also a Wi-Fi channel, which you can only join if you have at least one Wi-Fi token. There's a Lido community, which you can join. There's one group for staked ETH holders, right? There's one group for LDO, Lido token holders. And this is very interesting because it's more of a Web3 type product, and it leverages some parts of blockchain technology that aren't normally thought of that much, which is that your wallet is kind of an identity. And I think that this is potentially another moat we could build up, where if we're able to create useful communities to people where they naturally group together and they spend time together sharing alpha, sharing information with each other, that's something that could become quite valuable over time. And I think when we think about what parts of Nansen you might decentralize over time, I think Connect could be an interesting one. because it is much more Web3 native than some of our other products. Yeah, so I think those are maybe the three ones. The first one is definitely data. That's probably 80 to 90% of our moat today. And then there's kind of the brand and the trust and the quality and authority associated with being an information provider. And then the third, over time, is that we want to spend time on building out these social networks.
Yeah, I'll just jump in real quick there. I mean, the Wallet Connect thing is quite amazing. I think it's very early. Probably it's very undervalued from a product perspective. Because clearly it's not as popular as say Discord or Telegram, but it really gives an incredible advantage for users. And I was discussing with Aurelie of Nansen, of your team, a few months ago about it, and to me it's really incredible because you keep the anonymity, but you're sure that the people that you're talking to are part of the same group. So as you said, maybe
Yes.
so part of
Yeah,
the
and
Lido, or
yeah.
even go even more with the labels. You can talk to I don't
Mm.
know, like high balances, for example, or smart money or smarter money, smartest money, all these labels, and this is great.
Yeah, the cool thing about it, and this is kind of a realization that I had a bit later after we started building this product, because first of all, I wanted to build this product since maybe, I think, over 2 years. And then it took us a while to get the resources together to actually start working on it. But one realization I had is basically every token is potentially a community, because every token has multiple holders, and those holders have something in common, namely that asset in its, like, at least they have that in common. They might have more things in common. But so the cool thing is that with something like Telegram or Discord, you rely on people to create the groups and then bring people in. But with something like Nansen Connect, the groups latently already exist. So you're just creating kind of like a way to tap in into those existing communities, which is kind of if you think about it, it's kind of a cool idea. It's almost like there is this skeleton out there of all these different communities and kind of branches of that. And then you're just kind of allowing them to start speaking together. It's like you're switching on a light in a way, and then they can start talking to each other. And so, by the way, like we're talking about it. So if people listening to this or watching this want to try it, it's at connect.nansen.ai. And we just recently opened it up for everyone so that you don't need to have a Nansen account. You can connect there with your wallet, and you could check out which communities you have access to. And like you said, also, if you're a Nansen user, there are certain label groups that you can join. For example, there's a smart money channel. If you've managed to earn a smart money label in Nansen, you can jump into that channel and a bunch of other ones. So it's a pretty cool thing. But we don't know where it goes also. Like we need to see that this is something that people actually think is valuable, that they keep using it. So we're carefully monitoring all the usage metrics, and hopefully we will find ways to make it a really engaging product that unlocks a lot of value for users, and also that integrates nicely with the rest of the Nansen products.
What I see bringing the most value right off the bat, just from kind of thinking about this idea, is especially when it comes to things like discussing governance proposals, right? Like,
Yes.
knowing that somebody giving an opinion, especially if it's a strong opinion, actually has skin in the game, and you can verifiably prove that, makes a big difference. Like, it's like, imagine me having a very strong opinion about an election going on in a country I have nothing to do about, and saying that it makes all the difference in the world, and everybody taking me seriously for it, right? It's like, and I think that oftentimes happens in crypto, where you can especially have bad actors who may want to manipulate or influence the outcome of an event. And so they present themselves as some sort of large and heavily invested stakeholder, when in reality, it might be the competition or something like that, right? Aiming to seek for the downfall of that particular protocol. So, just in conversations,
We have some features coming out around this use case, and it's pretty cool because, like Simone said as well, you're kind of flipping it on its head. Whereas today, like, you would go into a governance forum, and very often you will disclose your identity, but the people might not know how many tokens you have. In Connect is like the exact opposite. No one knows who you are, but you can see how many tokens you have. And so that might, skew the conversations in a slightly different way, because people know, oh, this is actually a large contributor to the community, and you can verify it. You can see it directly because they're speaking from that address, right? So I think there's a lot of interesting stuff that you can enable for token oriented communities. And I'm pretty excited to see what we're going to be able to ship. And of course, hopefully people will engage with those features that we're rolling out as well.
I know that you are constrained on time, Alex, but do you have a couple more minutes to keep going here, just so we can touch on a few things?
Yeah, we can go like 5 more minutes if that's okay.
Perfect. Yeah. So I was just going to ask, one of the things that you shared recently as well is you were really excited about Google selecting Coinbase to take cloud payments of crypto and using its custody tool. And you mentioned that that's because compute was your second biggest cost driver and headcount was the first. And as you just mentioned, with those capital raises, you're deploying those to good use now. You're already paying staff in crypto via deal. If you can pay Google Cloud with crypto too, 90% of your cost will be paid in crypto. Enabling business to go bankless will be a huge win for our industry. So, of course, this is a very broad question, but walk me through why this would make such a difference to you guys as a company, and how this advances the future of the industry as a whole, and kind of wrapping up the segment here.
Yeah, I think if you just go back to first principles and make things really simple, at some point you have to allow individuals and businesses to just pay all their bills in crypto. That's like how you can go bankless, right? And if you also then, typically individuals will get their income from being a team member or an employee or contractor for a business. And so if the business can have all their bills or expenses covered in crypto, they can, in theory, like switch off the bank. They don't need the bank anymore. So you can go fully crypto native. And then again, if the individuals also can, if one day pay their bills with crypto, they also don't need a bank. So you're liberating yourself from the banks, and you're creating optionality, which I think is good for consumers and for businesses. And honestly, I think a lot of people who join crypto, at least 50% of their motivation is because they hate banks. And that's at least how I feel about it. Maybe not 50%, but definitely a significant portion of it. And I just feel like banks have had too much power too long, and consumers and businesses deserve to have options. And so when I saw that announcement, I got really excited, because I went through this exact thought process a few years ago, and I thought, what are the main things that you should focus on to make sure are available through crypto payments for a business? And I thought the first one is probably being able to pay your staff. And that's kind of, I'm not going to say it's easy, but you could do it manually, or now there are actually, good products that allow you to do it. Deal is one good example that we use. But then infrastructure and cloud and compute in general was like the second thing that was on my mind. It's also the second cost we have, as I mentioned in that tweet. And so that's already a huge part of startups that just basically pay for those two things. In a remote first world, at least, where you don't necessarily pay for office space, or that's not like a major part of it. If something like WeWork or Spaces also allowed for crypto, I think then you're really far in having tech startups being able to just pay for everything in crypto. So I think that's kind of where we have to get to if you want crypto to just be accepted everywhere. And there's kind of a tipping point where so many use cases can be paid in crypto, and people choose to pay in crypto, that's going to create this virtuous cycle where more merchants and more types of businesses will have to add support for it, because that's what consumers and businesses expect. And I mean, I'd be very surprised if AWS doesn't follow suit and do something similar here, right? And that's driving crypto adoption. And maybe one thing that is very important in thinking about this is that we now have stable coins, but a few years ago you didn't really have stable coins. You had Tether for a while, but people didn't necessarily trust that so much. Now first of all, Tether has been hardened even more, And there is some kind of Lindy effect going on with Tether. The longer it survives, the lower the chance is that it will collapse. I think there's no risk of, well, there's very low risk of Tether collapsing. But you also have now Circle, which is great for USDC. You have Paxos behind the scenes of Binance USD, and also with their own stablecoin. So, and then of course you have DAI, right? So stablecoins, I think, are a key part of allowing people to pay for their expenses in crypto, and also for businesses to pay for expenses. So it might seem like a small thing, but I think it's actually really important for crypto adoption to increasingly cover the total budget that you have in terms of what you can pay in crypto.
Yeah, I mean, powerful statement. You know, we're not the Bankless podcast here, but I think that's something we're certainly in agreement about. Yeah, I mean, the only thing I'd add to that is make it easy for those of us who are in places where you do have to pay taxes, paying taxes in crypto. That would also be a huge step forward.
That's a huge, yeah, absolutely.
Yeah.
You could kind of go down the list and see, well, you know, real estate for individuals, right? Paying your rent or potentially paying your mortgage, paying for food, paying your taxes. Like, you don't need that many items like that before you cover 80-90% of your expenses. And so hopefully, I mean, you also have things like debit cards now with crypto and so on. But yeah, this is a really important area for the overall adoption of crypto for payments.
Love it. Well, anything from you, Simone, before we wrap up here?
No, really. Thank you very much, Alex, for joining us. Huge fan of Nansen and all the products that you're building. We didn't really talk much about Portfolio, which is another one favorite of mine. Recent acquisition of you guys, but yeah, thank you for coming as always.
Yeah, thank you so much. So people can go to portfolio.nansen.ai to try that out, or you can also just go to nansen.ai to check out our products. Thanks for having me, guys.
Yes, thanks for joining, Alex. Thanks, Simone. See y'all later.